In this video, we're going to talk about tracking your progress and determining a method to make sure you're on track to reach your retirement goals. When it comes to investments, most people just really look at one thing, and that is their statement balance. That's definitely part of it, but that's not the whole piece of whether you're on track and whether you're going to reach your goals. In my opinion, the best metric to use is your actual net worth. So what is net worth? Net worth is basically everything you own and the value of everything you own minus everything you owe. So let's talk about a few examples. Everything you own would be all your brokerage balances, your home that you live in, any investment real estate you have, the equity in any business you own, any airplanes, yachts, cars, all of that. Basically everything you own that has value. Whereas everything you owe, most of the time, the largest piece of that would be your mortgage on your primary residence, any loans against your investment property, any student loans, any credit card debt, any car loans, all of that stuff. So we put all that together and we basically get a net worth statement and we get a number and we see this is my net worth. Our goal is to increase that net worth over time. The first responsibility is to figure out what that is. And a lot of people don't really do that. A lot of people just go and sit down with a financial advisor, and the advisor only really focuses on the part that they manage. Financial advisors are notorious for looking for more assets, but there are some assets that basically will never become under their care. So once we get that net worth value, then we need to pay attention to how big the pie is. So remember, we talked about the M2 money supply. If my net worth is going up slowly but steadily, but that piece of the pie, the whole entire value of the money in the system, which we call M2, if it's increasing at a greater rate than what my net worth is increasing, then that basically means my piece of the pie is shrinking. That's what we don't want, especially if we're in the younger years and we're growing and we're trying to accumulate wealth. We want to enlarge our piece of the pie, which basically means our net worth needs to track better or increase at a faster rate than the overall growth of the money supply. As we've already seen, from 2000 to 2025, the average annual increase has been 6.8%. It's hard to believe that's the case, but that's the real number. So basically what that means is, if you're having a year where you're only up 4.5%, and you go sit down and talk to your advisor and they say, well, the market had a tough year. We had a lot of fixed blah, 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 whatever. This investment didn't do so well this year and it kind of dragged us down, but we've got it rejiggered and we're going to do better next year. I'm here to tell you, if you average over the long term lower than that hurdle rate, that number, you're going backwards. And that's the part that you really need to pay attention to when you're doing your financial planning and working towards your retirement. If we look at the three phases that a typical investor is in, they're either in the young professional or accumulation stage, then they become into the pre-retiree stage, and then they become retirees. That's obviously the goal, is to work until you don't have to work anymore, then you consider yourself retired. Well, if you're in that young professional accumulation stage, your net worth should be growing a lot quicker than what the money supply grows. You have to be in the accumulation phase. The worst mistake that young investors can make is to be too conservative. I've talked to people who are so risk averse, they're so afraid of loss, that they basically have all their money in cash. If you do that, you are locking in 2%, 3%, 3.5%, whatever you can get as a yield in the bank or wherever. But inflation is going to run away from you. And I mean, you could have $1 million today, and in 20 years, that $1 million is not going to buy the same amount of stuff that it will buy today. That million has to grow. It absolutely has to grow. And you can see that looking backwards. That problem is not going to get better. It's going to get worse going forward, in my opinion. So you have to have a plan for growth. If you're a pre-retiree, then that you still have those same challenges, because if you're pre-retiree, you're probably in your mid to late 50s, early 60s, getting within a few years of being able to say, I'm done, don't have to work for a paycheck anymore. But you've got to be very careful to make sure the amount that you do have is protected, because what you don't want is to have a big drawdown right when you get ready to start needing to withdraw money. So you've got to have protection in place. We've talked about that in prior videos, but you still have to have a growth mindset. You want your portfolio at least keeping pace with what the overall pot of the pie, or the overall pie, is growing. So again, looking backwards, that 6.8% from 2000 to 2025, that's a pretty good number if you're in that pre-retirement stage to say, I want to make sure that I'm beating this on a year-over-year basis on average. And then obviously once you get to retirement age, you may be drawing out quite a bit more of your money if your investments from dividends, from different activities to generate income. Let's say you're making 6-7% a year, but you're withdrawing 5-6% a year. Then you're, in nominal terms, your portfolio is staying pretty steady, or maybe slowly increasing, or maybe slowly decreasing, depending on how much you're withdrawing and how well your investments do. But again, you're probably losing in real terms. But the goal is to keep that loss at a minimum, or to figure out some way to at least try to break even in real terms. The worst thing that can happen is you retire at age 62 and you live 30 years and you think you're in pretty good shape when you're 62, but you lock in, you get too conservative, and what once was a pretty nice sum of money has become worth less and less and less as far as producing quality of life. So you've got to have that mentality of real return versus nominal return, and you've got to have a plan to keep up. So you don't just lock in and think that you're doing okay, and then you wake up one day and realize you're not because you weren't paying attention. So let's talk about the typical financial advisor relationship that a client has with financial advisor. Most people go in once or twice a year. They do a review of their investments. They look at their investment balance. They get an idea of how well they did. If they have real estate issues, if they have debt issues, if they have anything that's not in the purview of the basket of investments that the financial advisor is sort of responsible for, most of the time you're not going to get a lot of advice in that area. And the simple reason for that is because the system that most financial advisors use is the assets under management, or assets under care system. And the financial advisor is incentivized to bring more assets in where they can help you manage. A good financial advisor should be doing some financial planning, should be helping you with taxes, should be helping you figure out a withdrawal plan and which accounts and what order to withdraw from, should be helping you with risk management as far as insurance and estate planning, all of that stuff. But most financial advisors focus only on the assets that they manage. Let's talk about the different fee models in the financial advice business. Going back 15 to 20 years ago, generally the model was a commission-based model. And that basically meant if you went in to sit down with a financial advisor, they would talk through your risk profile. They would figure out, again, how to manage risk, is how much in equities versus how much in fixed income. They come up with an allocation. They propose some sort of investment plan. A lot of times that would be mutual funds, bonds, sometimes individual stocks, sometimes annuity products, some sort of structured product. But most of the time there would be a commission that would be paid up front. That commission could range from as low as 1 to 2% and as high as maybe 10%. That comes off the top of the money you invest. That's the way the financial advisor makes money. I don't have to tell you that there are a lot of conflicts in the commission world. A lot of times advisors would end up selling products that were basically suitable, was the standard, but they would sell the products that paid the most commission. And if a financial company wanted advisors to sell a certain product, they just offer much higher commissions, and that's the product that would get sold. So that model it's still out there, but it's been pretty much replaced in general by what's called the fee model, or fee-based model. Most RIAs, which is a registered investment advisor, subscribe to the fee model, and that's basically where you pay a percentage of your assets under management as an annual ongoing fee. And what this does is it allows the advisor, instead of offering you a specific product and charging you a commission, they basically can buy and sell inside your account, but they just charge you a ongoing advisory fee that's based on the amount of assets. So if you have $1 million and they charge you a 1% fee, then your fee is $10,000, and that's per year that you would pay the advisor. Those fees range for very, very high net worth folks as low as probably 0.6, 0.7% up to about 1.5 to maybe 1.75% on smaller accounts, which basically usually are under $1 million. In that $1 to $2 million managed account range, you can usually use 1% as a general rule. So in my opinion, the fee-based model is very superior to the commission model, but it still is prone to have lots of conflicts. Let's say you inherit $300,000 and you walk into your financial advisor's office and you say, "Hey, Mr. Advisor, I've just got a check for 300 grand. I'm looking for a good solution I want to make it grow, but I want it to be conservative. I don't want to take a lot of risk, but I want it to grow." Well, that advisor is very, very incentivized to get that money under his care because that's the way he increases his fees. So if, let's say you have 4 options. Option A is invested in mutual funds. Option B is invest in a real estate deal that your friend has put together, and it would be a really good investment. It would diversify you because you don't have any commercial real estate. Option 3 would be to pay off your mortgage. And option 4 would be to buy a Tiffin RV that you and your wife can travel the country in. So you got 4 options A, B, C, and D. What do you think the advisor is going to offer or going to advise you? There's no doubt they're going to lead with option A and pretty much have a pretty good argument for why B, C, or D, none are of the same caliber as option A. Whatever reason they give doesn't really matter. Their bias is ingrained to get that money under their care so they can advise you because that's the way they get paid. That's the model. One of the newest models in the financial advisory world is to charge fees based on net worth. It's a new model that I really like because it takes away that bias and that potential conflict going back to our situation. So option A, if we decide to invest it in their managed account, that's great. Option B, the commercial real estate, again, that's great because it increases their net worth. They have an equity position and a piece of property that shows up on their net worth statement as an increase. Option C, pay off the mortgage, that's fine and dandy as well because if we decrease the liability side, the net worth goes up. And option D is the motorhome. Although that would be considered a depreciating asset, it's still an asset. It's still got worth and it still increases the net worth from the overall statement. So if the client comes to me who is charging a net worth based fee, they can do option A, B, C, or D, which means I can give totally unbiased advice without any conflict at all. And I can even spend time helping them analyze the real estate deal. I can spend time helping them decide if the Tiffin versus the Prevost is the best motorhome. Whatever, I can act as their financial advisor knowing that my fee is paid to me based on giving them unbiased advice on anything they can do with the money. My goal is to increase their net worth year after year. So again, I don't want to suggest that a typical financial advisor with an AUM model or even a commission model is not an ethical person. What I'm saying is the system is built where it has bias and conflict. Even the AUM model, which has less conflict than commissions, still has conflicts because another example, let's say a person retires and they have a 401k plan and that 401k plan has really good investments. It has very low fees and there would be absolutely nothing wrong with leaving the money in that 401k plan after retirement because those investments are doing well and they fit very well with the overall portfolio. A regular financial advisor would never advise that because they can't get paid. They don't recognize any fees. They have to get the money moved over under their care to be able to charge asset-based fees on it. That's where a rollover is the bread and butter for financial advisors. They work with clients until they retire. When they retire, they roll over their 401k to a traditional IRA or a Roth to a Roth, but the reason they do that is because they're incentivized from a fee perspective to roll those over. Sometimes it makes sense. You have more flexibility. You can invest in anything you want. You can do different things in an IRA than you can in an ERISA-based 401k account. But the point is, what if? They're not going to answer that question, is it better to leave it there because their system is set up in such a way that they basically have to do it that way to get paid. So let's think about what we talked about in the last video. If a person starts doing research and they decide, hey, it makes sense, I want to own some gold bars, or hey, it makes sense, I want to own some Bitcoin and I want to hold it myself with my own keys, not on any kind of exchange. Well, a typical financial advisor that gets paid under an AUM fee model, there's no way they're going to advise that. And the reason they wouldn't even delve in and do the research to see if it was a good idea or it made sense, because they can't get paid. If you charge fees based on net worth, it doesn't matter where your worth is. You're looking at everything and you're much, much more holistic in the way that you help people with their finances and their net worth and try to help make it grow year after year. So as I've mentioned, at my firm, I have adopted this net worth based fee model. I'm very excited that I can be basically the consigliere or the CFO for a person, help them figure out what their actual net worth is, and then have a plan to grow it year after year after year. The software that we use is very robust, and we put everything in and it basically tracks the net worth. We use that in our financial planning model in our meetings. And I think it's a great system. I think it's the way of the future, especially with alternative investments becoming more and more prevalent and making more and more sense. The traditional 60-40 model of 60% equity, 40% bonds, I think that is on the verge of being dead. We're starting to see more and more people realize that any kind of bond investment or fixed income investment is going to get absolutely hammered in the next 5 to 10 years. It already has in the last 2 or 3 years. And I think we're in the second inning of that trend, because inflation is going to continue to run hot. We're going to continue to print money. And I think you have to be much more open and much more holistic the way you look at your net worth growth to keep up with real return of your purchasing power. In the next video, I'm going to talk specifically about what I do and how I work with clients. And the goal is to define who would be a good fit to potentially reach out and have a discussion.